As of 11:52 a.m. Eastern Time, SoFi Technologies, ticker SOFI, is trading at $27.49 per share. That is a drop of about 1.19% on the day, or 33 cents into the red. The market is, of course, open and actively trading this name, which has seen a wide intraday range so far, bouncing between a low of $26.96 and a high of $27.95. This is all happening on significant volume, with nearly 32 million shares having already changed hands before lunchtime, putting it on pace for another very active session compared to its 3-month average. While the stock is pulling back today, the immediate price action is almost a distraction from the much larger story that just broke, a development that fundamentally alters the company's positioning. SoFi just announced the launch of SoFi Crypto, making it the first and only nationally chartered, FDIC-insured bank in the United States to offer consumer cryptocurrency trading directly within its ecosystem. This is the very thing the market has been speculating about, and it lands at a fascinating time for a stock that is already up more than 80% year to date. This move is the physical manifestation of CEO Anthony Noto's recent comments calling blockchain a supercycle technology, and it's a direct challenge to every other financial institution. The common belief, the broad expectation for SoFi, has been one of linear, aggressive growth. Investors see a company that successfully navigated the complex process to get a national bank charter, a move that dramatically lowered its cost of capital. They see a one-stop shop that is executing, proven by its very strong third-quarter earnings report on October 28th, where it beat estimates and raised its full-year guidance. We saw revenue grow nearly 38% year over year, and more importantly, net income surged an impressive 129%. The expectation from the retail community, especially on forums across X and Reddit, is that SoFi is the next great financial super app, and this new crypto offering is just pouring fuel on that fire. The assumption is that this news should be sending the stock toward its 52-week high of $32.73. And yet, here we are, looking at a red day. This is the tension between expectation and reality. The reality is that despite the blockbuster news, SoFi is running into a wall of valuation concerns and deep skepticism from the professional analyst community. While retail investors see a rocket ship, Wall Street sees a stock trading at a P/E ratio of over 50 and a price-to-sales multiple of around 12. In the current macroeconomic environment, with policy uncertainty from the Federal Reserve, those are very rich numbers. The reality is that the consensus rating from 13 different analysts covering SoFi is not a strong buy. It's not even a buy. It is a hold. And perhaps more jarringly, the consensus price target is sitting around $26, which is materially below the $27.49 it's trading at right now. The market isn't necessarily selling the news. It's being forced to ask if this crypto news is enough to justify the premium that has already been built in. This recent volatility, including today's pullback, is the market trying to digest this. The stock ran hard into its recent 52-week high just a few weeks ago, likely on the anticipation of this kind of announcement. Now that it's here, we're seeing some profit-taking and a classic show-me response from institutions. This is a high-growth, high-beta name, and in a market worried about what the Fed does next, it will get tossed around more than a stable old-guard bank. This push-pull dynamic is what defines SoFi as a trading vehicle. To understand where it's going, we have to respect what it is. SoFi began its life as a specialist in student loan refinancing. But that is ancient history. Today, it operates as a full-fledged, chartered bank with three distinct segments. First is lending, its core, which includes student loans, personal loans, and home mortgages. This is its profit engine. Second is the financial services segment, which is its member acquisition flywheel. This includes SoFi Money, checking and savings, SoFi Invest, its credit card, and now SoFi Crypto. The goal here is to get members in the door with one product and then cross-sell them into the others, especially high-margin personal loans. The third segment is the technology platform, which includes Galileo and Technesis, a B2B infrastructure business that other fintechs and banks use. The crypto launch is squarely aimed at accelerating that financial services flywheel, attracting the exact young demographic that is its bread and butter. Now, we have to talk about the short interest. With any stock this volatile and this popular among retail traders, there is a constant discussion about short sellers and potential manipulation. Let's look at the actual data. The official short interest is currently 9.31% of the free float. That is not an insignificant number. It translates to over 110 million shares being held short. This is a substantial, concentrated bet that the stock's price will fall. But this is where the story gets nuanced, and it's where investors need to look deeper. The expectation might be that this is a stock primed for a massive squeeze. The reality is more complicated. The cost to borrow SoFi shares is, at this moment, very low, hovering around 0.3 to 0.4%. This means it is not a hard-to-borrow stock. Short sellers are not panicking, and they are not paying a high premium to maintain their negative bets. Furthermore, the days-to-cover ratio is only 1.27. This metric tells you how long it would take all shorts to buy back their shares, based on average volume. At just over 1 day, it means the shorts can get out of their positions very quickly if they need to. This low days-to-cover number actually reduces the likelihood of a sustained, cascading short squeeze because there is no trapped and panicked rush for the exits. What's your take on that 9.31% short interest? Is it a smart hedge against valuation, or is it a misplaced bet against the crypto news? For investors who want to track this, you can find short interest data on platforms like Fintel or directly from the exchange. But the story doesn't end there. Retail traders often point to off-exchange volume, or dark pools. The off-exchange short volume ratio for SoFi has been high, recently running between 27 and 39% on any given day. This means a large portion of short trades are not happening on the lit public exchanges. While this is legal and common for institutional trading, it can be used to mask large short positions and can contribute to price suppression, which is a major frustration for the retail community. We also see occasional spikes in fail-to-deliver data, which is published by the SEC. We saw FTD spikes of over 234,000 shares in mid-October and over 380,000 in September. FTDs mean a party failed to deliver the shares on time for settlement. While there can be administrative reasons, a persistent pattern is a red flag that traders watch, as it can imply synthetic positions or settlement system stress. The short thesis itself is not complicated. It has nothing to do with SoFi being a bad company. It is a pure valuation argument. The bears are betting that a bank trading at a 50 PE ratio in a high interest rate world is fundamentally overvalued. They are betting that member growth will slow, that credit quality will eventually normalize, or that this new crypto venture is a low-margin, high-risk distraction, rather than a profit center. On the other side, institutional ownership remains robust at over 55%. The F13 filing season has shown a fascinating conflict. We saw Cathie Wood's ARK funds trimming their position in